video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. And instead of trying to go one by one down the list here of all the exchanges or crypto lenders that have had issues or are having issues, thought that this pair of tweets here sums it up quite succinctly, in that the general outlook in the near term, macro notwithstanding, is very likely continued range-bound behavior until some of this restructuring, liquidations, layoffs, assets, liability, mismatch, right? All this stuff gets cleaned up, because it looks like there continues to be not major exchanges, in my opinion. Most of these exchanges are kind of, as SBF said the other day, third tier exchanges, I guess you could say. But they do, some of them hold or did hold a significant amount of crypto. So there's a continued feeling of waiting for the next shoe to drop. Which exchange will it be next? Which exchange will halt withdrawals or come out with an announcement about layoffs? You know, I see one every other day at least now. Mainly exchanges laying off employees. So certainly not bull market things right now, at the very least. And if we look at exchange balances just for BTC, they continue to decline, basically at 4-year lows now. And I think a lot of that recently has been in response to what's been happening surrounding crypto lenders in custody and 3AC and the general sentiment. Certainly there was already a declining trend in balances for Bitcoin, for Ethereum. It's actually been rising, which is kind of surprising. But this is more of a picture that I'd expect from exchange balances relative to price. In a vacuum, I expect exchange balances to decline in a bull market and rise in a bear market. Basic supply demand. So this makes much more sense to me than seeing the BTC stuff, where we're continuing to see declines, right? In general, most people have to send coins to an exchange to sell, which is why this is a pretty good metric of selling pressure or selling volumes. Increasingly, though, off-chain avenues are ramping up for digital assets where they don't necessarily touch the things that are measurable in many ways. So that's an interesting dynamic here between ETH exchange balances and BTC exchange balances. Something else that's happened, obviously, is the contraction of stablecoin circulating supplies. Peaked somewhere near 200 billion in early May before Terra and UST imploded, and that's continued to decline, as one would expect when there's a major market event. There's some fear going on. There's some flight to safety going on. There's been more USDC issuance than Tether issuance, for example. That's the market saying to Tether, you need to clean up your reserves or become even more transparent than you already are regarding your reserves, clean up the commercial paper holdings, things like that, things which they are already doing. And I'm glad the market is incentivizing them to do that by redeeming Tether. There's been no trouble redeeming Tether thus far that I've heard from anybody, any rumor mill stuff, or externally anywhere publicly. And if we look at the stablecoin circulating supplies again, this is just Tether and USDC. Both of these are multi-chain, but collective circulating supplies are very likely to meet here quite shortly. Tether's redeemed 18 billion since the peak, seemingly without issue thus far. So that's certainly a win for them, and confidence in Tether and all the Tether truthers and the large short interest on Tether. I think if you're expecting Tether to blow up, right, you are short Tether, hoping that the bank run continues, and they don't have it, right? They don't have the reserves. And you're hoping it goes to zero if you're short Tether, obviously. But based on what they tell us, it seems like they're going to be fine for redemptions. Most of their commercial paper expires at the end of the month, this month, July. And they continue to look okay to me, based on what we can see and what they tell us, right? USDC has halved lending yields for the second week in a row. or they've halved them from 1% to 0.5% now. Lending yields across DeFi are down significantly as well. So there's not a lot of entities or individuals borrowing large sums of stablecoin right now. Typically, you borrow stablecoin to go long crypto, you borrow crypto to short crypto. Typically, that's how that works. So it makes sense. In a bear market, those things tend to contract. Nevertheless, Bitcoin's still here, humming along. We are still transacting and moving. These are transaction counts. One extremely simple, sort of diluted metric to see what's going on, the health of the system here. As we get a rise in alternative transaction methods referred to as layer 2, which for Bitcoin is Lightning Network, you see some transactions go either to a side chain or off chain or in places that may not be directly measurable in this case, right? So yes, transaction counts are down since the all-time high, remain down since sort of China left the game in the mining aspect, but we're still holding transaction levels since inception that are extremely high from zero, right? We're holding around 1 million transactions, around 1,000,006 transactions per week. Nevertheless, transactions still happening. Here's Lightning Network capacity. It works like a debit card system where in order to transact in Lightning, you need to basically present them to the network. The off-chain layer 2, it's not off-chain, it's more layer 2, but you need to present those funds to the network and they get locked in the network, and then you can transact with those funds in a debit-like manner. So we're seeing a rise in Lightning Network capacity measured in BTC despite price declining, which is a good sign as far as sentiment is concerned. Very few fair weather fans, it looks like, based on capacity, which continues to increase. Active addresses per week about 4.5 million. Again, sure, they're down from all-time high. They're flat. They're declining slightly, but this isn't a going to zero situation based on on-chain activity. There's still a ton of on-chain activity going on. And if we measure it in transfer volume USD, we continue to see on a weekly basis 550 billion over the past week. That's certainly down from 1.7 trillion, down from the peak at 2.4 trillion in a week. This is transfer volume. Now, this could be the same person, right? Transferring back and forth, or an exchange transferring between wallets. You have to curate the data a little bit to get a better signal here, but we're still seeing a significant amount of on-chain activity in USD as well, not only just transactions and active addresses. Something else I'd like to look at in a peak bear or peak bull situation is MVRV, which measures the market cap versus the average of all of the coins that have ever moved. What is their price? So it looks at the aggregate average on-chain price for coins relative to market cap. And historically, if the market cap is significantly higher, several multiples higher than the average aggregate cost of all the coins that have moved, that's typically closer to a top than a bottom, and the opposite is true if market cap is below the realized value for coins. Another way to think about this is unrealized profit versus realized profit. As we go up in price, there's a lot more pent-up unrealized profit. So as that gets realized, either by force or otherwise, that potential unrealized profit relative to when the coins last moved declines, right? So now we're in a zone historically where we've sat for a considerable amount of time, really, 3 months, 6 months, 9 months, 12 months, at least a quarter typically, aside from the COVID low, and we've entered the accumulation phase of the bear market. So certainly doesn't say this is the ultimate low, and we're probably not going anywhere anytime soon, which again fits the range-bound narrative. Range-bound for BTC, previously it was from 30 to 60. The current new range could be 20 to 30, right? For certain people, that's an extremely tradable range, depending on who you are and why you're here. Now, if you're a long-term holder and you're taking the long-term view, you're more than likely than not DCAing your way in these sort of prices. And you could care less, right, about MVRV or most metrics, but still we are at good lows based on MVRV. Bitcoin's hash rate kind of dropped off a little bit over the past couple months, let's say, but then it rebounded a bit. This is a good just health gauge for mining profitability. And are miners under stress? Are miners migrating, right? We saw that with the China migration here. Hashrate represents physical hardware, electricity, right? Much like a commodity, it is dealing with the real world interactions, okay? So it's very hard to fake this, if not impossible. And any deviations you see here mean that a device is being unplugged from the network or power is being shut off, ASICs being destroyed, however you want to think about that, by weather events, as we're seeing in maybe Texas and Montana. So we're continuing to see likely hash rate come behind these troubled miners or miners that have issues with their ASICs right now. We're seeing hash rate rebound a little bit here, which is kind of surprising even with prices as low as they are. Now, ASICs continue to get manufactured throughout a bear market. That doesn't change. There may be chip issues and import-export issues and all sorts of other reasons that may affect hash rate, not based on Bitcoin price. But what I can see here looks like we may be headed for just continuous highs in hash rate if more efficient ASICs get deployed, which is looking like that's coming sooner rather than later in a lot of industrial miners. And some of these weather events get cleaned up. We may see hash rate continue to increase. Puell Multiple is another, like the MVRV, an oscillator that helps tell you, are miners fat and happy at several multiples above what they were making last year? Or are they stressed? Are they making, on average, equal to or less than what they were making in the previous 365 days? So currently miners are sitting in that stress area, where on a USD basis, they're making, on average, at or below what they were making over the past year. So again, when we're looking for signals, this is one thing that historically has been rather clean. Honestly, it's sort of telling you, okay, are we super overbought? Are we super oversold? Are we in the middle of some sort of cycle? And right now it's pointing more towards oversold than overbought, certainly. Flipping gears to technicals here, Bitcoin's been in a bit of a downtrend. Obviously, that's an understatement, kind of since the Miami conference. I'm a big technical guy, and it certainly faked me out just based on technicals. Macro already looked in trouble even in April. They were talking about rate hikes, inflation fears, right? All that stuff was very evident even in Miami at that time, inflation, very evident. Nevertheless, we had this chart pattern that looked good, let's just say, for a breakout, even briefly broke above the 200-day moving average. But ever since then, we've very much been held within this downward channel. So currently, if we see any lower lows here, the expectation would be to the measured move zone between 13.4 and 15. So that's the further bearish case, bearish continuation, you could say. Another way to read this is a pitchfork, and we can continue sort of bouncing down on the midline. The midline is where price wants to live, so long as it remains within that trend. So if we're looking at sort of a micro snapshot of the near-term stuff, it's probably relevant whether or not we break the midpoint of this downtrend. Right now, we could remain in this downtrend even as high as 29.5, basically the previous zone, based on technicals. And certainly if we're below the 200-day moving average, that's the ultimate litmus test for bull or bear trend. But something else to watch here is the 200-week moving average, which historically we've not lived below very long. And the previous all-time high is also right around this level, which we've also not been held at or touched really ever. We've never really touched the previous cycle's all-time high. So in the near term, there is some confluence for the potential of an interim type of bottom, right? But again, macro, inflation, recession, all this stuff coming ahead of us likely doesn't bode well for anything being bullish right now. That's risk on, certainly. Strong dollar. I'll get to that at the very end. But it's certainly something to watch. If you're a lower time frame trader, I think the 22.5 level is definitely a key area to pay attention to. And another way to think about this for the bulls, on the bull side of things, this could potentially be shaping up to be an Adam and Eve double bottom. It's a type of W double bottom. It sounds crazy if you've never heard of it, but all it is a V and a U, a fast sort of V bottom paired with a slower curved shaped price. And the reason it has a name is because it's frequently seen, happens pretty often across all assets, but it is a type of chart pattern that fits pretty well here. There's also declining volume profile, which you generally want to see with any chart pattern. So again, if we can break 22, I do like higher highs. The question is, most people will be asking, right, is how high based on macro? That is the overdrop of everything right now. So this measures to 24, between 24 and 25, let's say, based on the height of this pattern. So if this does break 22, there's a reasonable expectation for that upside potential. Another way to look at this sort of in a longer term view is with the Ichimoku cloud, and how this works, again, much like any sort of MA strategy. If we're below it, we're bearish. If we're above it, we're bullish. If you're far above it, that says you're overbought. If you're far below it, it says you're oversold. And there tends to be an equilibrium, mean reversion type of movement eventually, right? Either the MAs will catch up with the price, or price will catch up to the MAs, depending on market conditions. And we're clearly bearish here based on the cloud. The cloud told you we were bearish when it broke down below it for the second time since November at 41-ish, 41,000. So we're below that level. We're below all of this volume between 30 and 60. And we've started to put in a volume node here at 19. Now there's a clear absence of volume from 19 to 27. Some people would also read that as a potential sort of gap fill scenario. Based on technicals, well, there's not a lot of upside overhang until 28. So nevertheless, I think all this needs tons of time. I would love to see what we saw in 2018. 2018, we saw a full quarter and a month of true bottom accumulation. It started with a falling wedge, inverted head and shoulders, the soup du jour of chart patterns, ascending triangle. We moved through the cloud. We got back above the cloud April 1st or thereabouts and moved back to the previous levels of VPVR. This was the gap at that time. But you can see the basing of accumulation we did from 3.4 to 4.3, somewhere around there. So I would much rather us take time than attempt to V-bottom into everything that's going on here. I'll take it, but that's where my head's at. On the price side of things, because I just think we're going to get smacked down in the near term based on what's happening with macro. Something else to consider when we're talking about mean reversions is the 20-week SMA, which historically, this red line has done an excellent job at determining sentiment, really. Are we bullish? Are we bearish? Are we above it? Or are we below it? We're currently below it. But again, this mean reversion potential is building as we are far below the 20-week SMA. Again, like 2018, 2019, this took time and price didn't catch up with the MA. The MA caught up with price, right? So that is the 3-month to 4-month picture of sideways accumulation on a high time frame level. So it's something I'm watching for already in Q4, I guess, right? Because ideally, we remain range bound. We clean up our act in Q3, liquidate who we need to liquidate, clean up the lending markets, help bring back confidence a little bit based on what's going on. And, we either deal with recession or we deal with a Fed pivot or non-pivot on rates. But it gives us time to digest everything that's been going on since May, really. So ideally, we take our time here. DXY, though, on the other hand, not taking its time at all. 62% of this is the euro. This is an index, and the euro is having a bearish moment, to say the least, as they have energy crisis issues, Ukraine, Russia war, trade deficits, all sorts of stuff going on in the Eurozone. And that is pushing the DXY higher extremely quickly. And historically, Bitcoin has generally traded inverse to the DXY, and that inverse correlation has been rising since March 2020. So it's not great to see DXY break a technical level, 20-year technical level or more, at highs here at 106.5. This thing looks like it wants to scream higher for sure. So that doesn't bode well for Bitcoin in the near term. And then lastly, just the NDX. Again, how much is the Fed going to want to crush this further? Will this mean revert on its own to the 200-day moving average? Is there any saving grace here on TradFi legacy sort of side of things to help crypto turn the corner really this entire quarter, right? Like my head is pretty dead set on range bound for the quarter. That could mean 15, it could mean 35, right? That's a massive range for Bitcoin, but a lot sort of depends on TradFi and legacy and macro. So some people like to think this is a bearish channel, and others maybe this is a falling wedge with a bull div, right? Time will tell how far this thing can actually mean revert. Do we reach down to 10.8 and attempt sort of a pivot to pivot move, a bear market rally, I guess you'd call it, to mean revert somewhere near the 200-day moving average? I don't know if any of that happens in any way, shape, or form, but it's something to watch in the next 3 months, definitely. So that's all I have for this one. Let me know what you think about markets in general, market health, market sentiment. Based on the market sentiment gauge from alternative.me, it has ticked up a little bit from 9 to like 15 over the past week. Like, dislike, comment, share, subscribe, and happy trading.